What should you do when the stock market crashes? Should you sell your investments to avoid further losses, buy the dip in hopes of a rebound, or hold tight and wait for better prices? The recent downturn has left many investors uncertain about the best approach to take. In this video, we'll break down these three strategies: selling, buying the dip, or holding, and help you understand which one might be right for your financial goals. Stick around to find out how to navigate these turbulent times with confidence. Let's get started. Understanding the crash. Stock market crashes can feel like a financial earthquake, shaking investor confidence and wiping out billions in market value within days. But why do they happen? A crash is usually triggered by economic downturns, high inflation, interest rate hikes, geopolitical tensions, or even investor panic. When uncertainty spreads, people rush to sell stocks, driving prices down even further. Take the 2008 financial crisis, for example. It started with the housing market collapse, leading to a domino effect that crashed global markets. More recently, the COVID-19 pandemic in 2020 caused a historic market drop within weeks. The current crash we're experiencing has been linked to rising inflation, aggressive interest rate policies, and fears of a looming recession. But here's something most people don't realize. Market crashes are a natural part of the cycle. Historically, every crash has been followed by a recovery. The key to navigating it isn't just reacting, it's understanding. So, what should you do now? Should you sell before things get worse, buy at lower prices, or just wait it out? Let's break down each strategy to help you make the best decision for your financial future. The selling strategy. When the market crashes, selling might seem like the safest option. After all, no one wants to see their investments lose value. Selling can prevent further losses, provide liquidity, and offer peace of mind during uncertain times. But is it really the best move? Historically, investors who panic and sell at the bottom often regret it later. Markets have a strong track record of bouncing back, and selling at a loss locks in those losses permanently. The 2020 crash, for instance, wiped out over 30% of the S&P 500's value within weeks. But by the end of the year, the market had fully recovered. Investors who sold out of fear missed out on significant gains. Selling should only be considered if your financial situation demands it, like if you need cash for urgent expenses or if your portfolio isn't aligned with your risk tolerance. Otherwise, making decisions based on fear rather than strategy can be costly. So, before hitting the sell button, ask yourself, is this a short-term panic, or do I truly need to exit the market? If you're unsure, there might be better alternatives. Let's explore them. Buying the dip. When the stock market crashes, some see panic while others see opportunity. Buying the dip means purchasing stocks at lower prices, expecting them to rise when the market recovers. But is this strategy right for you? Historically, markets have always rebounded. Take the 2008 financial crisis. Stocks plummeted, but those who bought in at the bottom saw massive returns over the next decade. Even in 2020, when the market crashed due to COVID-19, it bounced back within months. This proves that downturns can be great buying opportunities, if you choose wisely. However, timing the bottom is nearly impossible. Stocks can keep falling after you buy, leading to short-term losses. That's why experts recommend dollar-cost averaging, investing small amounts over time instead of going all in at once. This reduces risk and ensures you don't buy at a single, potentially bad price point. The key to buying the dip successfully is investing in strong, financially stable companies that are likely to recover. Avoid risky stocks that might not survive a prolonged downturn. Before you jump in, ask yourself, do you have extra cash to invest? Can you handle potential short-term losses? If so, buying the dip could be a smart, long-term strategy. Holding and waiting. When the market crashes, some investors choose to do nothing, and that's often the smartest move. Holding means keeping your investments intact, trusting that the market will recover over time. This strategy has proven successful for patient, long-term investors. Take Warren Buffett, one of the world's most successful investors. He famously advises against trying to time the market and instead focuses on staying invested. Why? Because the stock market has always recovered from crashes. Even after major downturns like the Great Depression, the dot-com bubble, and the 2008 financial crisis, the market eventually rebounded and reached new highs. If you have a well-diversified portfolio with strong companies, holding might be the best decision. It prevents emotional decision-making, avoids locking in losses, and allows you to benefit from future growth. Of course, holding isn't for everyone. If you're close to retirement or need short-term cash, waiting might not be ideal. But for younger investors or those with a long-term perspective, riding out the storm is often the best path to success. So, now that we've covered the three main strategies, what's the best way to approach a market crash? Let's discuss expert insights. Expert insights. Financial experts agree on one key principle. Successful investing is about discipline, not emotion. When markets crash, fear and panic lead many to make hasty decisions, but the best investors stay calm and follow a strategy. Experts recommend focusing on long-term trends rather than short-term noise. History has shown that while crashes are painful, markets have always recovered. The S&P 500, for example, has bounced back from every major downturn in history. Instead of reacting emotionally, experts suggest maintaining perspective. A bear market is temporary, but market growth is permanent. Another key expert tip is diversification. Investing in a mix of stocks, bonds, and real assets reduces risk. If one sector struggles, others might perform better, balancing your portfolio. Dollar-cost averaging is also highly recommended. Investing a fixed amount regularly, regardless of market conditions, smooths out volatility. Most importantly, financial advisors emphasize having an emergency fund before making major investment decisions. This ensures that you don't have to sell assets at a loss if unexpected expenses arise. By following these expert-backed strategies, staying invested, diversifying, and managing risk, you can turn a market downturn into an opportunity rather than a disaster. Strategies for navigating the crash. Navigating a stock market crash requires a clear, well-thought-out strategy. Here are some key steps to help you make the right moves. Number 1, assess your financial position. Before making any decisions, ensure you have an emergency fund to cover at least 3 to 6 months of expenses. This prevents you from being forced to sell investments at a loss. Number 2, stick to your long-term plan. If your investments are based on a solid strategy, don't let short-term market movements scare you into making rash decisions. Historically, patience has been rewarded. Number 3, diversify your portfolio. Reduce risk by spreading investments across different asset classes like stocks, bonds, and real estate. This helps cushion the impact of market downturns. Number 4, consider buying the dip wisely. If you have extra funds, look for strong, undervalued companies and invest gradually rather than all at once. This approach, known as dollar-cost averaging, helps manage risk. Number 5, avoid panic selling. Selling at a loss locks in those losses permanently. If you don't need the money immediately, holding on often leads to better outcomes. By following these strategies, you can turn a market crash into an opportunity rather than a setback. Stay informed, stay patient, and invest wisely. Market crashes can be stressful, but smart decisions can turn challenges into opportunities. Whether you sell, buy the dip, or hold, the key is to stay informed, assess your risk tolerance, and think long-term. Don't let fear dictate your moves. Stick to your strategy. If you found this video helpful, don't forget to like, share, and subscribe for more insights on making the right financial decisions. Thanks for watching. Until next time, stay smart, stay invested.